Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today I want to go over some Twitter information over commodities. There's a chart I really want to talk about. It's right behind me, the oil supply outlook from Aramco, Saudi Aramco, the big boys. And the crisis here could be much larger than what most people think. The energy crisis is what I'm referring to. And I really want to cover this information, get you guys this information so you guys understand what's coming. I don't know the exact shortage that's coming, but I do think it's going to be a shortage. And it's about oil. Let's just dive in here. I'll talk about it here. It says the long-term oil supply outlook is bleak per Aramco and others. 30 million barrels of oil per day supply gap in the next 8 years. Aramco is forecasting a 30% supply shortfall. And this is the chart that should just burn this image into your head. This is the oil supply outlook. This is your millions of barrels per day. This is your time frame. They are projecting forward from 2022, where we are today, and they've got three things on this chart. This is the global supply at natural decline with no new investment. This is your decline rate if you didn't have any investment. This is the global supply with current level of spending is somewhere in this range here. And then we've got all this new investment required to make up this gigantic gap. What that gap is roughly 30 million barrels. It's actually greater than, it's 30 million. It's a little bit under 80 here, a little bit over 100, 106 there, for this gigantic shortfall. 30 million barrels is gigantic, guys. We're talking about a 30% gap. Now, we will start to feel this gap at any point in the future when this thing starts to diverge, the demand and supply diverge. This demand supply is very inelastic, the demand is. So it's very hard to kill off the supply. And we've been basically using barrels from the Strategic Petroleum Reserve to hold us over for this summer. They've been releasing like 1 million barrels. So what's going to happen is when they stop releasing those barrels, and if let's say we get a little bit of a decline going on, we could get slapped in the face with a pretty big inventory drawdown if this transition between Strategic Petroleum Reserves and production isn't dealt with very smoothly. And pricing's going to it's going to be jerked around quite a bit. I know they're trying to push the oil prices lower for elections. But what happens after elections is anyone's guess with the Strategic Petroleum Reserve not releasing more barrels. Maybe they release a little more. I'm not exactly sure how they're going to transition off the SPR. But again, this is a huge gap out there. I am investing for this gap. That is where the money is going to be made. What happens in the short term is just going to be opportunities to be buying more, in my opinion. That's what I'm going to be doing. Obviously, I can't give advice, but that's my opinion and what I am doing. But that's what it looks like, guys. That's a horrifying look, and I hope that we can figure out a solution here. I don't think that gap's going to be filled with electricity-driven solutions. And I don't think you're going to have a major, if this is coming, guys, I don't know how we're going to have this gigantic mining boom of, electric vehicle minerals and renewable minerals all at the same time that this is happening. We're probably going to have resource wars and other things that are going to be much more dire of a situation than figuring out how we're going to mine some stuff for some electric vehicles or for some renewables. Coming on down, here's U.S. oil, the 4-hour chart. I think this broke to the downside already. There's that one there. So here's another one I asked. This was a question I asked. It says, what is worse, missing the big move or a 70% decline from the top? Now, I invested pretty early in my positions. I've already had to go through some pretty large declines, some of them being 70% from a decline from a peak price at some point. I am in it for the big move, and I'm actually riding things up and down in a 70% decline in some of the companies. I've gone all the way up. I've had a 70% decline. I've added more, and I continue to ride higher. It highly depends on where you buy the stock. You will, in some of these small companies, experience a 70% decline during a bull market. That is how volatile a lot of these companies are. So the key point here is you don't want to miss the big move, but you're probably going to have to endure 40, 50, 60, 70% declines from a potential topping point. It's going to happen, and you're going to have to prepare yourself mentally to do that. What I can do to help you out is get you those good entry points. The entry points prevent you from getting a 70% decline reading in your portfolio. So what I do is I buy low, I time my entry points, and if you want to follow how I'm buying these and what I'm buying, the Platinum membership in the description link below, you can become a Platinum member in that on the website, and you can follow me and see what I'm doing because I post what I'm buying in those question and answer sessions. I talk about what I'm buying. I have midweek updates, and those midweek updates can get you the information that you need to prevent yourself from chasing or FOMOing into a stock or company. And I get it. Everybody FOMOs, but I buy when they're down, and that's when your risk reward is the best. And I think that missing the big move I am afraid of missing the big move, but you're going to have to ride through some pretty big volatility to get the big move, unfortunately, in commodity type stocks. Here's Guy. He says goals before the age of 30. And I agree with this mainly. It says build an emergency fund. It says side hustle at $1,000 a month, exercise daily, read regularly, take a big risk, pay off debts. It doesn't mean take all big risks. You can take a big risk, but properly allocate your risk to reward. Find your true passion, become location independent, have a relationship, start an online business. I like this mix here. I think it's a pretty good mix. The one that I'm really working on myself is to become location independent. That is really cool if you can become that. Online business, location independent are all kind of tied together. I like this one. Buy assets and act broke. That's how you get rich. It's the difference between what you make and what you spend, and then invest the rest. Here's one. This is Shubham Garg. It says, the EIA drilling productivity report is out, and another significant downward revision in oil production estimates. August production was adjusted down 160,000 barrels per day, with Permian accounting for 73% of it. What happens as the world slowly accepts the fact that peak shale is here? And, we've got peak shale here. We're talking about shale oil in the United States. This is those numbers of July versus August, and they were lower by 160,000 barrels. Where is, when I go back up to here, I'll just show you again, where are these 30 million barrels going to come from in the world? Where is this shortfall going to come from by 2030? This is on our doorstep, guys. This is going to happen to us from here on out. And if we're not growing in shale, if we're not growing on these, areas in the United States, where's this oil going to come from? We need 30 million barrels. We need 3 Saudi Arabias. We need 3 Americas. We need, or one of each. I don't know where that amount is going to come from. I think it's going to get pretty dicey in oil and energy here starting right now, going forward after those SPR releases are done. Mining needs to increase by 500% to deploy wind, solar, and battery tech. 3 billion tons of minerals need to get pulled out of the earth, according to a World Bank report. Art Berman saying there's not enough minerals in currently reported global reserves to build just one generation of batteries for all EVs and stationary power storage. Now, what I'm doing is I'm going to tie this together. Mining needs to increase by 500% to deploy wind, solar, and battery tech. How are we going to do that with a 30 million barrel supply shortfall in oil? Do you understand kind of what I'm getting at here? If you have a shortage of energy, do you think we're going to go on a mining boom of 500% in mining increase at lower ore grades, which requires exponentially more energy to get out of the earth? Well, that sounds like a predicament that we're in. Is it a problem or a predicament? A predicament has outcomes, problems have solutions. Do we have solutions for this? I don't know if we do. Here's one. It says inflation-adjusted U.S. 10-year yields are fueled up and ready to unwind. This will support an important run for gold and silver. When it breaks down below the sleep mode line, a massive repricing for the precious metals and miners will be enacted. And what he's saying is that when this breaks lower here, that it's going to be a fuel for gold and silver. If that works out that way, the 10-year yield not keeping up in relationship to the producer price index. That's what this ratio is. So it's basically saying real negative yields for the most part there. More real negative yields, gold and silver is going to take off. Inflation running away from the 10-year yield that they control. Interest rates. It's going to be pretty hard to increase North American production when there's no available frac capacity. And this is North American market is tight. This is Canadian frac industry. This is U.S. frac industry supply and demand. The supply is contracting in both of these. Demand is starting to come up, and you can see the active versus the cold stacked that's sitting there. We're really starting to get this market to be tight, and that's what that open cold stacked area is. So we're coming up on tightness in the energy service companies. I think with the shortfall that's coming in oil, that energy service companies will be an excellent area for investment. And I'll just go over these down here. So supply of equipment is contracted, leading to tightness in Canadian and U.S. fracturing markets. Remaining cold stack capacity is very costly to bring back online. New build timeframe is approximately 12 plus months. Finding labor is a barrier to further capacity adds. Lots of supply constraints and resource constraints for energy services. It says Warren Buffett's Berkshire Hathaway has plowed over $25 billion into Chevron and Occidental this year. One energy guru suggests why. And that's himself. I think he was talking about this in some of this, according to Josh Young. Here's also some more information. Wind and solar installations plummet caused by rising costs, supply chain bottlenecks, and a U.S. Department of Commerce investigation into illegal imports. Wind fell 78%, solar fell 53%. This is quarter two clean power installations comparisons to quarter two 2021. Massive decline in installed capacity. Storage has gone up a little bit. Wind and solar capacity has really declined. Can we go into an energy crisis and have these be profitable? I don't think so, but we'll see. I talk about Moo. This is move over the stock market. Looks solid for a move higher. This is the agribusiness. It has been moving higher. We've broken that downtrend. It's looking real good. And VanEck agribusiness ETF looks pretty solid. I said Leonard Corp on a log chart. Does this look good or bad? We've broken this resistance line to the upside. We've done a retest. I usually buy the retest and then I hold and move higher. The question I have for everyone is, why is Leonard Corp's chart look so pristine and perfect for a move higher if we're in a housing crisis? That's for you to decide on what you think that might mean. But I think that housing's probably going to go higher. And then we also see Homebuilders ETF doesn't look bad. Broke out of its 10-year plus consolidation period and now moving higher again. And, we're seeing the homebuilders with some pretty good strength. Is this a crisis going to extend into housing? I don't know. I'm watching the data. I don't see it yet. It doesn't mean it can't. It just means I don't see it yet. And the homebuilders are acting pretty resilient in the face of all these people who are so bearish. Here's one. It says, got copper. And this is Anglo American's new boss sounds warning of future copper supply. The world is headed for a severe shortage of copper, crucial to the green energy transition as new mines become increasingly difficult to bring online. So even Anglo American's CEOs like, where is this copper going to come from? Where are all these minerals going to come from in this green energy transition? These institutional investors that have been pulling their money from oil and gas just posted their worst first half since the financial crisis. Go woke, go broke. I thought that's funny, but this is their as they U.S. college endowments post biggest loss since financial crisis. So what happens when you pull your money out of what I think is going to be great investments going forward? Here's one. E&P stocks are starting to really outperform oil recently. That's what energy bulls, or says that's what energy bulls want to see. We got the downtrend line. The ratio of XOP to oil is starting to break to the upside, where the mining companies, the energy production, explorer production companies, are starting to outperform oil itself. This is where things are going to heat up, guys. We just experienced this little move here. If we can break this, we're going to see a big old bull market in oil. The gains that are already had, I think, were kind of just from such a low, depressed area in history that we haven't really seen this. Now it's time for these guys to really, I'll say, stick it to it. We're really going to start to outperform oil, and I think oil is going to go up massively these next couple of years out. It says, are oil and natural gas going higher here? Just as an opinion, a lot of people said yes. I got to be careful because a lot of people are usually wrong. So I think we're going to probably continue to pull back in oil. Oil does not look ultra strong at this time. And natural gas does look very strong at that time. So there is a kind of divergence here between those two. Oil will catch back up and go higher. We'll see what that exact timing is. But that's what I've got for today, guys. If you guys are interested in joining the channel, definitely subscribe. Give me a thumb up for the content if you like the content. In the subscription link, again, it's the Platinum membership's the membership that I would choose. If you like the membership, if you like the picks, if you're making a ton of money, and I've had a lot of really good picks over the past few months, they do take time to play out. I'm not a short-term, when I'm not trying to time this stuff short-term, I'm trying to build wealth. If you want to build wealth, I think it's a good spot to join. Read up on the financial education stuff, read up on position sizing, read up on kind of gaining an insight in how commodities work, what to look for, the cost curves. I got all that stuff on the website. Once you understand that, you can start asking some good questions like, what are some of the highest leverage natural gas companies that I could partake in? Why are you selecting these natural gas companies in certain areas? Why is natural gas on an international pricing separate from the Henry Hub? What is connecting these prices? Once you start connecting all these things together, what you're going to find out is you're like, man, this guy's got a pretty solid plan put in place. And there's a lot of thought behind the companies that I'm going into. And I'm basically exploiting price differentials throughout the world. That's one of the strategies. I also think that the market conditions are quite ripe for certain sectors to do incredibly well in over this next 5-10 years. As you can see, oil's got some major problems. Natural gas has major problems right now. Coal's going to have problems. Uranium's going to have problems. They're all tied together. Everything is interconnected in these markets. As people have, these things that you're watching here, YouTube, social media, things are getting even more interconnected. Things are traveling faster. There's going to be more volatility. So I think everything is interconnected. I think that we can position over the next decade very well and have very, very good returns. It's going to be quite volatile, though. When I say volatility, we could see some recessions. If the energy production side isn't up to snuff, things could collapse a little bit in short-term movements. And then we're going to run at it again. We'll get another shortage. It's going to be an interesting decade. And I'm going to ask some of these questions, I think, for Doomberg and some of these other guys that might come on. because he's going to be coming on here over the next 2 weeks. I think 2 weeks out. I got him scheduled. I'm going to ask him about that, about some of those questions. So that's what I've got for today, guys. We'll catch you next time. This is Finding Value.